Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. It's half-year profit season on the ASX, and this is the week that things really kick off. Over the next weeks, all companies with a December 31 half or full-year balance date will update investors on how they're going. Always a good time to check in with Matthew Kidman, Principal at Centennial Asset Management, to find out what he's keeping an eye on. Remember, this is general information only. You should get professional advice before making any investment decisions. Matthew, welcome back to Fear and Greed.
Hi, Sean. How are you?
Well, have you come back into the new year, which admittedly is about 5 weeks old now, or 6 weeks old, full of vim and vigour for this reporting season?
Well, if we're going to talk about reporting season and how people are feeling going into it, it's completely different to what would have been 5 or 6 or 7 weeks ago when we were heading into Christmas break and the markets had sold off a bit. And then we had this incredible rally over January. So expectations in general have changed a little bit, which makes it harder for companies to impress because prices are generally higher. We had that rally. It's pretty broad-based. It wasn't any area in particular. Most stocks went up during January. So now the expectation is, make your numbers, give us a good outlook. Otherwise, we're going to be a bit nervous on the downside.
Okay, so we've had a few companies come out in the last week that things really kick off this week. AGL was a big one from last week, Suncorp, etc. What are some of the themes that, it's probably too early to say have emerged, but that you're looking for over the next 3 or 4 weeks?
Yeah, so the last 3 years have been dominated by thematics, or as you economists like to say, macro. So it's a good every 6 months to kind of do the micro, which is the companies. And that macro does feed down into the micro. So we've had those handful of companies you've said. Two things really stand out. That the economy, the Aussie economy that most Australian companies are exposed to is still strong, with an expectation of slowing as the calendar year unfolds. The other thing, obviously, that's hit us, that's already been here, is inflation. And how do companies handle that? And can they pass those costs on? So you mentioned Transurban, big tollway operator in Australia and offshore. Their contracts to run those tollways is, inflation indexed, which is terrific. They've been able to do that. So their numbers come out, they pretty well hit the mark. Other companies won't be so lucky, but so far, so good. We saw in the insurance sector, you mentioned Suncorp. Well, IAG actually pre-announced a week or so back, and they got clobbered by inflationary claims. Suncorp was able to manage it. It got bought on day one. So they're the big issues that are affecting the individual companies.
Okay, so can we go into some of the sectors? I know retail is one that's held by many, many people out there. What do you think it means for the discretionary and the consumer staples coming up?
Yeah, that's interesting. It feels like that people got the discretionary wrong at the back end of last year. Things were going to be stronger for longer. And that's kind of played out now. A lot of stocks have rallied, but the expectations are that we will see a slowdown sometime in this 6 months. Now, they've been expecting that for a long time, but it's been a bullish area. So I would think that unless, and we saw Nick Scali, who are the furniture manufacturers and retail outlets, they had a great result, but they said January was down on last year. And so the market sold that aggressively. So that's what the market's looking for, signs that things are slowing down. And so I think consumer discretionary is going to be tough to actually be able to put out the results and so their share prices go up. It'll be rare. The staples, on the other hand, seem at last to be coming to grips with the inflationary environment, which we talked about before. And there's a general feel towards those defensive sectors because last year inflation was hurting them. They were passing it on, but they were lagging. Now it seems like food prices are moderating and you're getting those price increases are helping their margin. So it's turned a little bit. So there's a reasonable amount of expectation about Coles, Metcash, and obviously Woolworths, even a little bit for Wesfarmers. They sit in the middle of discretionary and staple, obviously with Bunnings. And then you've got Endeavour, which was spun out of Woolworths. So they're the ones that the market is heading towards. It's a bit more defensive.
All right, I just want to talk about tech stocks for a moment. It seems that is one sector where the macro theme really still is maybe not dominant, but very, very important because as soon as there's expectations of higher rates, the tech stocks seem to get sold off and then the opposite also.
Correct. It's been interesting talking about this the other day with a few people. The tech market in Australia is not very deep, nothing like the US and parts of Europe. But we do have a handful of reasonably sized tech-related companies. And then we've got a whole bunch of smaller ones who are trying to get out of the ground and become those bigger companies. The larger companies are doing a great job, whether it be Technology One, WiseTech, and the like. They've been able to pass on those cost increases, but they're expensive. And your analysis is if interest rates go up, and we're talking the longer dated bonds here, because when you analyse what a company's worth, you're doing the discount rate of what it's worth today on future cash flows. Those bond rates yields go back up, which they have in the last couple of weeks. Those stocks struggle. I got to say, at the smaller end, in more aspirational technology companies, which there's a lot more of, it's been very difficult. You get the odd one like Nuix, which has been a colourful character on the share market since it listed. It got a good result during the week in the sense that one of its legal cases went in their favour and it bounced. But generally, those small, struggling to be profitable tech companies, I don't see a lot of light for them at the moment. And the big ones, they're going to rely on interest rates rather than outrageously good earnings.
Stay with me, Matthew. We will be back in a moment. My guest this morning is Matthew Kidman, Principal at Centennial Asset Management. Industrials, it's a sector which is actually hard, a sort of amorphous group of companies out there when we just put them all in the industrials. We have had some come out, and they're a group where you can really see inflation hitting basically input costs, but often they're passing on to customers. Emcor, I think, was an example from that last week. What do you think about the industrial? Well, firstly, who are the industrials, and what do you think about them?
Yeah, the industrials are a collection of various companies, Amcor being one of the bigger ones, Brambles. They've got great overseas exposure. Then you go down even to steel companies and other manufacturing companies like a Reliance and so on. So some are exposed to different sectors. Their real problem is just what you've hit on. They've got two great things to convince investors on. Inflation, which Amcor came out, numbers looked all right, but they were struggling to pass on their costs, and they're lagging, which we talked about with the retailers before, the staples. And the industrials, that's what they've got to cope with. Can they pass their prices on? How much of a lag is there? And they're going to be doing it into a time when most things around the world are slowing. Maybe not as quickly as we thought at one stage, but the economies are generally just easing off. The US, Europe, and probably 3 or 4 months later will be Australia. So it's going to be tough for those companies.
Financials, it's not actually a big time for financials because 3 of the big 4 banks don't report, although we get quarterly reports. But Commonwealth Bank will be out. We've had Macquarie Group, which was a pretty good result. What do you think of them, financials?
Yeah, well, Macquarie was the first, just about the first one. They gave us a quarterly update, and it was very good. But as usual, Macquarie can pull a lot of levers, so it's slightly different to our big mortgage-based banks. I think you get a really good result from CBA. It's the biggest. It's important. You'll get a good result. We saw, with Macquarie, with their banking arm, margins are pretty strong at the moment with that, net interest margin. And we saw with ANZ, they put out their quarterly earlier this week, and bad debts were down. Everything about a good economy showed up in the balance sheet. But maybe it's peak in terms of their margins because, the competitive nature of deposits, which funds their, the bulk of their balance sheet, was very good for a while, but now people are jumping over each other to give you better deposits and so on. So it's begun to become harder. So this might be peak time for the banks, but I think what you'll find is they will report, or Commonwealth Bank will report, and the others will give their quarterlies, and they'll look pretty good. And that'll be that might push them a little bit higher, but as I said, the 3, 4, 6 months out might get a bit tough for them.
Okay, I want to mention healthcare, and then I want to go into small caps because you've obviously spent a lot of your years looking at small caps particularly, but just quickly, healthcare.
Healthcare is interesting because, once again, it's various companies, but a lot of them at the big end have overseas exposures. And so in this period, it's going to be hard because they're going to be fighting a stronger Aussie dollar, which has been rallying 3 or 4 months in a row. But I think they kind of get support over time, especially if we can't stop the interest rate cycle. If the Fed's got to keep going, if the Reserve Bank's got to keep going into the middle of the year, it's probably a safe place to be because they are defensive. And if the US has got to keep raising interest rates, we get a bad inflation number next week, that US dollar is probably going to firm. Just keep an eye out for that. That's not a bad place to be.
Okay, so small caps. Matthew, you've spent a lot of time looking at small caps. How do you think they will perform over the next 6 or 12 months vis-a-vis large caps?
Yeah, I think over a 12-month period, you're going to get a good return. There's no doubt about that because they've been sold off. There's more opportunities across a lot of different industries. So I wouldn't like to say everyone's going to perform. But I think this reporting season is going to be very tough for them because it's going to be really hit and miss. As I said, if it was back before Christmas in December when everyone was a bit down in the mouth and valuations were lower, but things have rallied 10, 15% for a lot of companies. And I kind of think this is going to be the messiest results season because it's a transition from an old economy that was doing quite well to where we're going with higher interest rates, and there'll be a slowdown. And I think that makes it hard in the short term for most small caps, not all, but a lot. And there'll be a lot of volatility. As we talked about before, it's hard with reporting season now because it's a trading event for most people. So the key here, if anyone's watching results, is look at them, but maybe just take a few days to digest it because we'll see company prices move around a lot and probably not justified. But I think most of them will report decent results, but their outlook will reflect that things are slowing down globally, especially in Australia where they've got the exposure. Now, if we get some benign inflation numbers and the Australian dollar, especially out of the US, and the Australian dollar continues to firm, so it's come from 62 cents, got up to 71, now back to high 60s. If it firms, that's always a great sign for the Australian small cap market. It means that people aren't as nervous, people are a bit more confident. So just keep an eye on that Australian dollar. If the Australian dollar falls back into the mid-60s, I think it's a tough time in the short term for small caps.
Matthew, thank you for talking to Fear and Greed.
Thanks, Sean.
That was Matthew Kidman, Principal at Centennial Asset Management. This is the Fear and Greed Daily Interview. Remember, this information is general in nature. And of course, you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.